Well, we know the European economy had a very difficult year last year. There were lots of questions as to exactly why it slowed so dramatically, whether it was temporary factors like problems in the auto sector. But I think what became increasingly clear was that Europe is being very badly affected by the slowdown that we've seen in the Chinese economy. And that's really what we're seeing in those numbers this morning. It was really the slowdown in exports that is driving that weakness.
So how much of this has to do with trade and resolving these global trade tensions?
Only in part, I would say. I think this slowdown began in China long before actually we heard a lot more about Washington's trade agenda. That was really caused by the tightening of domestic policy in the Chinese economy. So as we look through that lens, you could say the outlook for this year is more positive. We've certainly seen the Chinese authorities take their foot off the brake and put it back on the accelerator. That bodes well for Europe. But I do think the trade agenda is crimping global capital spending. CapEx intentions are falling pretty markedly around the world. And I do think that's as a result of the uncertainty that's caused by the trade war. And Germany in particular, but across Europe, are capital goods producers. And until that uncertainty resolves itself, I think that's going to continue to weigh on global capex and Europe in turn.
Yeah, experts so important in Europe, approximately half of the GDP in the Eurozone. I know that the European Central Bank is meeting this morning. We're expecting to hear from Mario Draghi in just a little more than a couple hours now. What are you expecting to hear about monetary policy for the Eurozone?
Not a lot. I mean, this is the problem in Europe. The toolkit is looking pretty bare. We're already in negative interest rates. Unlike the US, there's been no normalization whatsoever. Expanding quantitative easing or doing anything of size in that field would be very difficult because they've bought already the limit of what they can pretty much in the German Bund market. So we're looking at minor changes at some point with regards to forward guidance, then promising to keep interest rates at low levels for an even longer period of time. Or perhaps what the market's really hoping for is to hear that there's some more liquidity on its way. These long-term refinancing obligations, these cheap loans they've provided to the banking system, they are set to roll over in the next 12 to 18 months. And I think that's the most we can hope for, really, is to hear that those loans will be extended.
The OECD has also warned that the UK faces recession in the event that they can't get a deal on Brexit. How do you plan around the uncertainty surrounding Brexit?
Well, it's a very critical week next week. So next Tuesday, the Prime Minister is going to put the Brexit vote that she has negotiated back to UK Parliament. We'll see. She needs another concession from the EU for that to have a hope of going through on Tuesday. But then importantly, the next day, Parliament will vote on whether it would accept no deal. And I think it's at that point that you will see a resounding majority in Parliament against no deal. There's still a question then of how we move forward to actually striking a deal. But I think for markets, for the economy, there will at least be some solace that there is no majority within UK Parliament for no deal, which avoids some of those risks that, as you say, the OECD are pointing to.
Karen, can you see a catalyst for a turnaround?
Globally, I think, it comes back to that point we made about the trade war and uncertainty. I think it was Chairman Powell who said uncertainty is the enemy of business. So really what we want to see is this trade agenda, not only with China, but also with European autos, de-escalate, maybe even move towards a resolution. I think if we saw that, then there is still considerable scope for global capex to pick up. In terms of how long is left on this cycle, which is, of course, the million-dollar question on investors' minds, we know the labour markets are tight, but what has been very lackluster in this recovery has been investment spending. So if we really want to see 2 or 3 years added to this cycle, that's what I want to see. I want to see the trade war resolved. I want to see capex intentions coming back, because that's going to give us some grounds for optimism that this economic expansion and therefore the rally has a bit further to run.